As South Africa scrambles to diversify markets and accelerate export growth, China is emerging as a sure bet. A landmark framework agreement on economic partnership for shared development, signed between the two countries, gives South African exports duty-free access to the vast Chinese market.
It is also an answer to unilateralism and protectionism. That shows South Africa and China hand in hand to open wider both their market to each other so that they can enhance our bilateral relations.
South Africa accounts for the largest share of nearly $300 billion in trade between China and the African continent. That figure is set to climb as the agreement opens greater access for key exports, including minerals, agricultural goods, and higher value processed products.
We've given them an initial list of 100 products, and those include manufactured products. But we've now said, now that we have this agreement, we can do a more comprehensive early harvest program that would enable manufactured goods to go into the Chinese market, and therefore you're able to add value to the quality of trade that you have with China.
Agricultural products, which have already gained a foothold in the Chinese market, are likely to feature prominently on the final list to be presented in March.
This agreement will open wider, of course, China's market to high quality South African products like rooibos tea, wine, beef, citrus, and nuts. But also it will benefit Chinese customers because they will buy these products with lower prices.
The deal goes beyond market access to China. Pretoria is positioning for a potential investment boost from its largest trade partner. South Africa is fast growing as an attractive market for Chinese automakers, gaining ground on traditional players.
There's a significant increase, in fact, of imports that we get from China, but there's also been appetite to invest in the country. More recently, Chery has made a deal with Nissan. We've also had commitment from BAIC, that was the initial company that invested in the country, to transition from semi-knockdown to complete knockdown, meaning actual manufacturing in the countries.
Beijing's zero-tariff move does not stop with South Africa. It extends to 53 African nations, broadening the scope of China's trade engagement across the continent.
It is also a time of great opportunity for our continent and indeed for our country as well. Global economic uncertainties, climate risks, and shifting trade patterns underscore the need for building economic resilience and capability, diversifying both our export basket and our exporter base is in the end key to our economic growth strategy.
Africa and China have crossed the threshold into a new trade era. For many debt-burdened African nations still grappling with the threat of reciprocal tariffs from the United States, the agreement represents a huge win. Producers across the continent now have easier access to one of the world's largest consumer markets, with the potential to boost incomes, industrialization, and economic growth at home. Julie Shara, CGTN, Cape Town.
All right, then, for a bit of analysis, let's bring in Kevin Adari, an analyst of economic ties between economies here in Africa and the world's second largest economies, joining us in studio tonight. Thank you for your time this evening.
Thanks for having me.
I want to start with exports from Africa into China last year. Relatively modest growth, 5.4% last year to about $120 billion. Should we expect comparable growth in 2026?
Well, I think it should be positive, and we should expect more growth based on a number of factors. The first one, of course, as you highlighted in your earlier news about this zero-tariff policy that now China has adopted for all African countries that have diplomatic ties with it. It means that African countries now have a bigger market in China to try to push their export into that market. The second one, of course, is the decision of China to facilitate export of African produce into its market through the Green Lanes Channel. This is providing technical assistance to African countries so that their products can easily gain access to the Chinese market. And I think the third factor has got to do with what is happening across the Atlantic, you know, the position taken by the Trump administration to cut economic integration and dealing with Africa. It's pushing African countries to actually diversify their export market, and China is actually the biggest that they're looking at.
Because they're
right
looking
now.
at that and something like AGOA, because I know the counter argument from the American side will be, you know, but we've renewed AGOA, but the response to that I've seen is that companies and policymakers on this end of the continent are saying, well, yeah, but you're only renewing it for a year. What
That
company,
is true.
what company is going to invest on the basis of a 1 year
There is no long-term
renewal?
basis to plan with AGOA right now, and the pain point that's already created because of that disruption is evident. You know, people are no longer investing. Companies are very jittery about the potential to go on with the US market. And honestly speaking, AGOA has never been that transformative in a sense that it only allows a few set of products to access the US market. And it's also based on the political whims in Washington. If they feel a country is not playing to the game, they suspend you from the trading. And so it's not practical to really plan with AGOA. And beyond that, of course, you know, the position of the tariffs, even though the Supreme Court tried to deal a blow on that, but many African countries, over 20, are still affected by the new route of new taxes that Trump is unleashing.
And this sort of erratic trade policy is going to be the norm, right? It's the standard from the Trump White House, and it will be in place for at least all the way to 2029, maybe 2030.
Absolutely.
But in the interim, how is it reshaping manufacturing and logistics here in Africa? Because we've already mentioned one angle of it, right? Because companies are saying, well, AGOA is going to be renewed on an annual basis, so I'm simply not going to invest at all. Are we seeing a lot more of that across many African economies?
Well, what we're going to see is more African countries trying to reimagine what they can do outside the US market. You've seen, for example, here in Kenya, the apparel sector, which supports about 600,000 jobs, 70% relies on the US market, and that disruption already caused a lot of pain points. And this is the same case
and it
for,
was even
for
worse
example,
with
Lesotho. Yeah, you know. And so what African countries are thinking is to overcome some of these difficulties is to increase intra-Africa trade, you know, trade more amongst themselves. But at the same time, look outward to see who else is more responsive to our trade and economic partnerships. And in that, they see China. So the US policies has disrupted manufacturing because the market is not as enthusiastic as it used to be. The extension is just for a short time, and nobody plans with a year in manufacturing and investments. People plan for decades, but here is a case where you have to plan for months, and you never know what's going to happen, whether they're going to renew it or stop it altogether. So it's becoming a little bit untenable for many investors in African countries to think about the US market strategically.
I want to pivot back to the green channel that you raised a little earlier with respect to exports from Africa getting into the Chinese market. Sure. Because yes, tariffs are off the table, right, from the 1st of May, but what are the key non-tariff barriers that a lot of exporters will still face? Because I know we'll speak about, for example, avocado, macadamia nut processors, and they'll say, well, no, it's a quality of the product. Is it in a state that actually meets standards in the Chinese market, that sort of thing. How do we fix those problems?
No, I think the issue here is that while China is very responsive to the needs of Africa, Africa has to step up, and of course the tariffs are out of the window, but there are more challenges that still face African producers and exporters to the Chinese market. And of course the first one, as you rightfully mentioned, is this issue of safety and phytosanitary standards. Yeah. China being a very important global market, it's not just for the African produce. So everybody in the world is looking at that market. And they have introduced standards and safety protocols that any exporter eyeing that market has to observe. And African producers and exporters are still struggling in that area. The second one has got to do with the nature of the exports of African exports into the Chinese market, largely raw materials as we speak. And so for them to benefit, they have to increase new product lines that can compete globally, but have got a strong basis of strong source in Africa. So if you remember, Kenya today, for example, is thinking about avocados, the anchovies and these other products that were traditionally not in the list of basket items that are being exported to the Chinese market. So I think that structurally, and then there is the issue of policy coordination. Many African countries still haven't gotten into, for example, strategic partnerships with China, which can facilitate even trade, including settlement. So,
because that's an argument for reshoring to some extent, isn't it?
Exactly. Yeah. So I think that while the Chinese are more willing, they are more responsive, they are coming up even with the technical specification to help the African side cope, I think a lot of work still remains on the African side for them to maximally tap into the Chinese potential.
And I want to wrap up with something that you just raised, right? Settlements, because we've seen one of the more interesting trends, I think, from last year was the incidents that we saw in Kenya's case, the announcement that, look, they've effectively decided to redenominate, using the wrong word here, redenominate the loan from the Exim Bank of China from US dollars into RMB. Ecobank's group CEO, Jeremy Awori, was on the program last week, and he said, he's seeing a lot more demand for direct settlement between the RMB and African currencies, so RMB Rand, RMB Naira, RMB KES, and so on and so forth. A, what needs to be done to speed up that process, but also B, do you think, especially given the fact that now you're exporting into a market, without tariffs, do you think that will essentially accelerate the adoption of the yuan across a lot more African economies?
Ideally, it should follow, but a few things have actually to be done. In my view, I think that Africa and China have to think about a platform that bypasses the dominant global payment systems like SWIFT. The China cross-border interbank system, for example, has been adopted and is increasing in popularity around the world. And African countries
so far,
need to think about it.
There's only one African bank that signed up
to it, right? So we need to see a situation where China and African partners work together to accelerate adoption of such platforms. The second one has to do with policy coordination from the China side and the African side. They have to come together. For example, very few countries in Africa have signed agreements around currency swapping, currency settlement of trade and investment in their own currencies. We need to see strategic more enthusiastic signings on that front. And of course, the other issue is we need to see more availability of the yuan in terms of liquidity and access. Because if Africa has to do with trade with China, then the currency has to be there. So countries, exporters shouldn't struggle in Africa to access the yuan. So I hope that they can internationalize, increase access, and for the yuan, so that anybody who wants to do business with China can easily access that.
Indeed.
Currency.
We'll see how this plays out, especially as we get closer to May. Kevin Saderi, thank you very much.